Hello guys, welcome back again to our YouTube channel Keleza Lestabza Tabiso Ranzi. So guys, in this video we are going to take a look at our statement of financial position, or in which is called what? Income statement. So guys, let's look at the definition of income statement. What is income statement? It is the financial statement that shows the income and expenditure of the business. It indicates if the business has made a profit or loss during the financial period. So now we understand, guys, that income statement is what? It's a statement that shows us what? Incomes and expenses, in order to what? For a business to see if ever they made a profit or they made a loss during our financial period, which is what? Which is a 12-month period. And then the income statement is the same as what? Trading account and profit and loss account, meaning what? That whatever trading account and profit and loss account we were doing is the same as our income statement. So guys, we have prepared ourselves, we have relevant knowledge, and we have relevant skills on how to apply our calculations. So now it's going to be easier for us to complete income statement, and then it is prepared to determine the net profit or loss generated by the business during the specific period, which is what? 12 months. So now guys, we are understanding what is an income statement. So in this video guys, we are going to take a look at the structure of the income statement. So guys, whenever you do income statement, you are going to have what? Sales. So you are going to find your sales from your what? From your pre-adjustment trial balance. So guys, it's very important for us to know our structure. So today we are going to talk only about the structure. And then guys, in sales we'll do what? We'll subtract our debtors allowance. We'll subtract our debtors allowance. So we are going to have an amount for sales from our pre-adjustment trial balance, subtract debtors allowance, and then we are going to have a total for our sales. So it's the same thing we've been doing in under our trading account. And then we are going to have cost of sales. And then cost of sales will be will be shown in brackets, because to us it's an expense in the business, the money is going out. And then we are going to say our sales subtract our cost of sales, then we have what you call the gross profit in the business. Then we have gross profit. Gross profit is made by by sales minus cost of sales, as they are showing us there. It's gross profit, it's sales minus cost of sales, and then we have our gross profit. And then guys, again we have other operating incomes in the business. As a business, we need to have incomes in the business, such as rent income. We are going to have an amount from our pre-adjustment trial balance, and then followed by any transaction. And then those transactions, we are looking for accrued incomes, whereby we are going to add, or we are going to look for income received in advance, whereby we are going to subtract, and then we can record our final amount. And then guys, again, some of the incomes that we have discount received, meaning whenever we buy goods and services, we'll get discounts. And then we are going to write the opening balance from our pre-adjustment trial balance, and then it will be followed by our step 2, whereby we are going to talk about adjustments. And then guys, we are going to record the final account. And then there are many incomes in the business, such as profit made from selling an asset in the business, and such as provision for bad debts adjusted, and many more incomes. So all your incomes will be under operating other operating incomes. And then we are going to add all our incomes. And then they are going to give us what? Other operating incomes. Then we are going to take our gross profit plus our other operating incomes. Then it will be what? It will be equals to what? Gross operating incomes. Meaning gross operating incomes is going to be what? Your gross profit plus other operating incomes, and then equals to what? Your gross operating incomes. And then guys, after that we are going to have other operating expenses. As they told us, income statement must show the incomes and the expenses of the business. So now we are going for an expenses, such as what? Trading stock deficit, as we spoke about trading stock discipline deficit. And then expenses such as what? Salaries. Then we are going to take an opening balance from our pre-adjustment, and then it's either we add or we subtract. If ever we overpaid, then it needs to be what? Subtracted. If ever we underpaid, then it must be what? Added. And then we can record our answer. And then same thing as packing materials, we are going to take our opening amount from our pre-adjustment trial balance, and then read the information, and then it's either we subtract the packing materials that were on hand, and then we are going to have the final amount, as well as depreciation, as since you know how to calculate depreciation using the diminishing balance method, as well as the on cost price method. Then after calculating depreciation, then you will record your depreciation. And then we have bad debts. We have been doing bad debts, guys, from our year-end debt adjustments, and then we record our bad debts. And then after completing our operating expenses, we are going to add them, guys, and then whenever we add them, then we'll have a total, and all our operating expenses, they must be showed in brackets, because is the outflow of money in the business. The money is going to go out of the business. And then, guys, from this stage, now we are going to take our gross operating income subtracted by our operating expenses, and then we are going to get what you call operating profit. And then, as they told us, is that it's gross operating income subtract operating expenses, then we have our operating profit. And then we are going to have our interest income, whereby it's going to be interest on fixed deposit, all the incomes that we are expecting from all the interest that we are earning, then they will be recorded as interest incomes, and then they will be positive. And then in this case, we are going to take our operating profit plus our interest income, then it's equals to operating profit before interest expense, and then it's operating profit subtract operating profit plus interest income, then equals to profit before interest expense. And then we record it, and then these two will be equals to this. And then, guys, we are going to have interest expense such as interest on loan. It's payable, then it's an outflow of money in the business, and then it must be shown in brackets. It must be shown in brackets because of the money it's going out of the business. And then at the end, we have net profit for the year. How do we find net profit before the year? We are going to take net profit before interest income, which is this one, net profit before interest income, subtract our interest expense, then we have our net profit at the end of our financial year. So, guys, please make sure you get home and you look at this structure, you practice this structure, and you know this structure by heart. And then, guys, I will be coming with another bang for a income statement, whereby we'll do some take a look at some adjustment related to income statement. So guys, stay tuned, subscribe, like, and press that notification button so that whenever I upload, you are notified. So guys, it's a bang.
Bang.